Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Walmart.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And just a quick housekeeping note before we dive into today's deep dive. Make sure you check out the StockOracle 14-day trial link down in the description.
Yeah, we are an affiliate, so it definitely helps support the show, but, standard disclaimer here. AI insights and value estimates can sometimes be wrong.
Oh, absolutely. Always verify the data on your own.
Right. And, of course, everything we talk about today is just for informational purposes for your own long-term wealth building. It is not financial advice, so please do not take it as a buy, sell, or hold recommendation.
Exactly. We're just here to unpack the research.
So, look, speaking of unpacking research, we need to talk about this massive paradox with Walmart today. What happens when a company's profit is just absolutely surging, but Wall Street is, aggressively hitting the sell button?
It's one of the weirdest disconnects I've seen in a while.
Right. Over the last 13 weeks, Walmart's stock has dropped over 12%. But their quarter one net income just jumped nearly 19% year over year.
Yeah, it completely contradicts traditional finance theory. You have a business generating more cash, increasing earnings, and the market is just actively discounting the entire enterprise.
And that specific disconnect is exactly what we are digging into today. We've got this highly detailed equity research report from today, August 20th, 2026. And the mission is to figure out, is Walmart just this struggling traditional retailer weighed down by a tough economy? Or are they secretly transforming into a high-margin tech giant?
Which is wild to even think about with Walmart.
I know. But if you have money in an index fund or you're just trying to build durable long-term wealth, this gap between the raw numbers and the stock price is just a masterclass in reading between the lines.
It really is,
Okay.
because the raw business performance in this report is staggering. We are talking about quarter one revenue hitting $177.7 billion.
Billion with a B.
Yeah, which is an 8.4% growth rate. They've beaten revenue estimates for 25 consecutive quarters now.
That's incredible consistency.
And the net income was $5.3 billion, up from $4.4 billion the year before. So the existing engine is clearly humming.
But then you look at the stock price. It's stuck around $114, and it's been trending downward for the last half year. It's like a restaurant where the line is out the door, right?
Yeah.
The cash register is ringing nonstop, the food is great, but the owner's valuation of the business just keeps dropping? Like, what is the market seeing that those massive revenue numbers are hiding?
Well, the market isn't really looking at the revenue anymore. It's looking at the expectations that are baked into the current price. Right now, Walmart is trading at a 40.6 trailing PE ratio.
Wait, 40.6?
Yeah, 40.6 times earnings.
I thought grocery chains were supposed to be like these boring defensive stocks trading at maybe 15 or 20 times earnings. A 40 multiple is something you usually see on a high-growth software company.
Exactly. And when a company is priced that perfectly, it leaves zero room for execution errors. The market looks at that premium valuation and gets terrified about any little bump in the broader consumer economy.
That makes sense. As someone who focuses on capital protection, a 40 multiple on physical retail makes me super nervous.
And you aren't the only one. The institutional investors are nervous, but the insiders at Walmart are actually hitting the exits too.
Yeah, I saw that in the report, and it totally stood out to me. The insider activity shows 22 open market sales totaling 8.8 million shares.
Which is a massive block of stock.
Right. And you want to know the number of open market purchases by insiders? 0.
Wow.
Not a single share bought by the people actually running the company.
Yeah, the research actually uses a metric called the monthly sentiment based on purchases and sales ratio, and it's sitting at negative 100. So it's exclusively selling sentiment.
That's brutal.
To be fair, insiders selling at a company this size can often just be, executive compensation, scheduled vesting, or basic portfolio diversification. It doesn't automatically mean the executives think the ship is sinking.
Sure, but optics matter immensely when you are demanding a tech company valuation. If the stock is down 12% over 13 weeks and insiders are selling heavily while buying absolutely nothing, it creates a very chilling narrative.
It really reinforces that fear that maybe the growth is about to hit a wall.
Exactly. It puts the burden of proof entirely on management. Because to maintain a 40 times earnings multiple, Wall Street has to be buying into a massive fundamental transformation story.
Right, which brings us to the core thesis of this research report. Because there is a massive transformation happening, they call it a mix shift.
Okay, let's break down this mix shift because traditional physical retail is a brutal low-margin game.
Oh, completely.
The report notes that Walmart's net margin is a razor-thin 3.13%. So, if you go and fill up a shopping cart with $100 worth of groceries, Walmart only walks away with about $3 in actual profit.
Right. The traditional model just relies on immense volume. You have to sell billions of items just to keep the lights on. But the report highlights two emerging engines that are just exploding right now. And they operate on entirely different unit economics.
Okay, what are they?
E-commerce, which grew 26% in Q1, and their advertising platform, which is called Walmart Connect, that grew 37%.
37% growth is huge.
It gets better. Those two segments, e-commerce and advertising, now make up approximately 1/3 of Walmart's total EBIT.
Earnings before interest and taxes.
Exactly. A full third of their operating profit is now coming from digital and ads, not from that tiny physical margin on a gallon of milk.
That's the aha moment right there, because the incremental margins on digital advertising are just phenomenally higher.
Oh, it's night and day.
Right, because when a brand pays Walmart to feature their product at the top of a search result on the app, there are basically no manufacturing costs.
No shipping, no warehousing.
Exactly. It is almost pure profit dropping straight to the bottom line. So they aren't just selling you the cereal anymore. They are selling the high-margin digital billboard space right next to the cereal.
Using all their first-party data to know exactly when you're most likely to buy it.
It's a commerce plus platform model.
And when you put those mechanics together, it creates this incredible flywheel effect. This is the core of their long-term growth driver.
How does that flywheel actually spin?
Well, it starts with the core retail business driving massive digital traffic. Hundreds of millions of shoppers go to the Walmart app because they need everyday essentials.
Right, toilet paper, groceries.
Exactly. And that massive digital traffic creates a huge amount of advertising inventory, places to put those digital billboards you mentioned.
And brands are desperate for that space. They will pay a premium to be seen right at the exact moment a customer has their digital shopping cart open.
Much more than they'd pay for a random banner ad on a news site. So that high-traffic ad space attracts more third-party sellers to the platform. More sellers means a vastly broader assortment of goods.
It brings in even more customers.
Exactly. Which drives more digital traffic, creating more ad inventory, and the whole cycle just accelerates.
Wow. So as that cycle speeds up, the percentage of Walmart's total profit coming from high-margin advertising gets larger and larger.
And that structurally lifts their overall operating margins. They become way less reliant on that 3% physical margin and more reliant on a 70% digital margin.
Okay, I see the vision.
Mm-hmm.
And that structural lift is exactly what justifies a 40 times PE multiple. The market is basically trying to price them as a tech platform.
Right.
But Sarah, looking at this, I have a major problem with the math in this report.
Uh-oh. What is it?
If this high-margin advertising business is so incredibly profitable, why am I looking at a Q1 free cash flow proxy sitting at negative $1.94 billion?
Wow. Yeah, the negative cash flow. Well, the cost of building that flywheel is astronomical. You don't just flip a switch and magically become a tech platform overnight.
No kidding. The report shows they spent $6.68 billion on capital expenditures just in Q1 alone. That's up from roughly $5 billion the year prior.
It's a massive investment.
But are they just setting cash on fire to pretend they're a tech company? Or is this $26 billion a year actually building a permanent competitive moat?
So let's provide some mechanical context on that negative free cash flow proxy first.
Yeah, please.
Because analysts use operating cash flow minus capital expenditures as a proxy to quickly gauge if the business is generating or burning cash.
And a negative $1.9 billion proxy sounds like they are bleeding out.
It sounds terrifying out of context, but cash flow in retail is highly seasonal. The report clarifies that if you zoom out to the full fiscal year 2026, Walmart generated a staggering $41.5 billion in operating cash flow.
Okay, that's a lot healthier.
Right. And against that, their full-year CapEx was $26.6 billion, So that still leaves them with a full-year free cash flow of around $14.9 billion.
Got it. So they are very much cash flow positive annually. The negative Q1 number is basically just them front-loading their heavy infrastructure spending early in the year.
Exactly.
But still, $26 billion a year on CapEx is an astronomical amount of money. From a valuation perspective, if I'm paying a premium multiple, I want profits returned to me, not sunk into endless corporate projects.
Which is a very fair point.
So what exactly is that $26 billion actually buying them?
They are funding three interconnected initiatives: automation, supply chain optimization, and store modernization. Basically, they are turning their physical footprint into hyper-efficient, localized fulfillment centers.
Okay, but when you say automation, you don't just mean adding more self-checkout lanes, right?
Oh, far from it. We are talking about automated retrieval systems, essentially robotics built into the back rooms of their physical stores.
Wait, really? Like full-on robots?
Yeah. In the past, when you ordered a mix of groceries and home goods online, human workers had to walk the aisles with a cart, which is incredibly labor-intensive and expensive.
Right.
But now, these automated systems pick and pack those items in a fraction of the time, directly from a micro-fulfillment center that's just built into the existing store.
Which mechanically changes the unit economics of an online order. The fulfillment cost per unit must just plummet.
It acts as a dual engine for margin expansion. The advertising drives the high-margin revenue on the front end, and the automation crushes the fulfillment costs on the back end.
That's actually brilliant, but, and this is the cautious side of me coming out, if they are sinking $26 billion into backroom robots, they aren't just doing it for fun.
No, definitely not.
You don't build a moat that wide unless you are terrified of the armies massing on the other side.
And the report is very clear about the external threats for the second half of 2026. Target is reportedly gaining significant momentum. They are potentially stealing market share in discretionary categories.
Right, discretionary meaning clothing, electronics, home goods, the stuff you want but don't strictly need to survive.
Yeah.
And losing a t-shirt sale to Target hurts Walmart way more than losing a grocery sale.
Because of those physical margins we talked about. A retailer might make a tiny fraction of a cent on a banana, but they make a really healthy margin on a winter coat or a coffee maker.
So if Target is siphoning off those higher margin discretionary sales, it puts immense pressure on Walmart's overall profitability, even if their grocery aisles are packed.
Exactly. But Target isn't even the biggest existential threat here.
Amazon.
They are aggressively expanding their drone delivery network to nearly 500 U.S. cities.
Wow. We've been hearing about drone delivery as a gimmick for over a decade. Is it actually a material threat now?
It's a direct attack on the unit economics of last-mile delivery.
Because the most expensive part of e-commerce is that final step. Paying a human to drive a 2-ton van through a neighborhood just to drop off a tube of toothpaste.
Right. And Walmart's defense has always been their physical stores. They have a store within 3 miles of 90% of the U.S. population.
So they use that local store as a hub to make last mile cheaper.
But a drone bypasses the road entirely.
Oh, wow.
It changes the marginal cost of that delivery to cents instead of dollars. Amazon is actively trying to short-circuit Walmart's localized flywheel.
If Amazon can use drones to rapidly deliver everyday items cheaper and faster than a human driving from a local Walmart, the value of that massive physical footprint just evaporates.
It diminishes significantly, yeah.
So we have this massive infrastructure spend on one side, and Amazon trying to bypass their entire physical footprint on the other.
It's a race.
And investors paying a 40 times multiple aren't going to wait 3 years to see who wins this logistics war. They are demanding proof that this strategy is working now.
Well, the immediate catalyst forcing the market's hand is dropping literally today, Thursday, August 20th, 2026.
The Q2 earnings report.
Exactly. And the options market is implying a massive 4.5% move on the stock based on this single earnings event.
Let's unpack what that implies mechanically, because options pricing allows analysts to calculate expected volatility. A 4.5% swing on a company the size of Walmart.
Yeah.
That equates to tens of billions of dollars in market capitalization being created or destroyed in a single trading session. For a legacy grocer, traders are bracing for a serious shock to the system.
The consensus expectations are 74 cents in earnings per share on $186.7 billion in revenue. But honestly, based on this research, those top-line numbers almost feel like a distraction.
Right, because the market isn't going to swing 4.5% just because they sold a few more bananas.
It is entirely a referendum on the mix shift.
The single most important metric to watch today is the growth rate of Walmart Connect. It was at 37% last quarter.
If that advertising growth stays elevated above the 25 to 30% range, it validates the entire thesis. It proves the high-margin flywheel is working.
And that the heavy capex is justified.
Exactly. But if it decelerates below 20%, that entire margin expansion narrative comes into question, and that 40 times multiple is going to look incredibly fragile.
We also have to monitor their e-commerce growth, right? That needs to maintain that mid-teens trajectory, because without digital traffic, there's no digital ad inventory to sell.
Yep. And the other critical near-term catalyst today is management's guidance for the full fiscal year 2027.
They previously reaffirmed guidance of 3.5 to 4.5% sales growth and $2.75 to $2.85 in EPS.
Right, so if management raises that EPS guidance, it signals massive internal confidence that the mix shift is successfully expanding margins, even with the threats from Amazon and Target.
But if they lower guidance, blaming consumer headwinds or competitive pressure, that negative sentiment we saw with the insider selling will just accelerate across the whole market.
It would be a bloodbath. But if we look beyond today's immediate volatility, the research report outlines a really fascinating 3 to 5 year blue sky scenario.
Okay, I love a good blue sky scenario. Though we should clarify, this is an optimistic projection, not a hard prediction, right?
Absolutely. This is what the business could become if management executes perfectly.
So what do the mechanics of that actually look like?
It basically hinges on two forces colliding. First, the advertising business scales up to become the dominant driver of their profit. And second, that heavy capex spending, that $26 billion a year, finally begins to taper off.
Because the automation projects and micro-fulfillment centers are fully built out.
Right. When the infrastructure spending drops and the high-margin ad revenue continues to compound, that negative free cash flow proxy turns into a massive geyser of distributable cash.
Free cash flow would just inflect sharply upward. You'd have a business where the low-margin physical stores basically just act as a break-even mechanism to cover fixed costs.
While the digital and advertising platforms drive nearly all the bottom-line profit.
At that point, Walmart essentially ceases to be valued as a traditional retailer. Wall Street fully embraces them as a tech platform hybrid.
And under that specific scenario, a 40 times PE multiple isn't just justified. It might actually be cheap for a company controlling that much consumer data.
So it would represent a structural re-rating of the entire enterprise based on the quality of their earnings, not just the quantity of their revenue.
Exactly. So what's your final wealth-building verdict here?
Well, to crystallize the base case from the research, Walmart possesses phenomenal underlying fundamental momentum. We're talking 25 straight quarters of beating revenue estimates and a rapidly expanding advertising flywheel.
Which is clearly their strongest long-term growth driver.
Right. However, from a capital protection standpoint, the stock is currently weighed down by a premium valuation that leaves zero room for error, aggressive insider selling, and massive near-term infrastructure costs.
Plus the escalating threats from Amazon's drone logistics, which is arguably their biggest threat right now.
It's a legacy giant in the middle of a profound metamorphosis, trying to rewrite its financial DNA while running at full speed. Today's earnings report will be the definitive clue as to whether that metamorphosis is succeeding.
Which leaves us with a final, pretty provocative thought to consider.
Yeah. As Walmart's high-margin advertising and digital platform businesses continue to aggressively eclipse their traditional retail profits, are we rapidly approaching a future where the physical products on the shelf don't even really matter to their bottom line anymore?
I mean, are the groceries just becoming the cheap bait required to capture our data?
Exactly. Just bait to hold our attention and power their real moneymaker. It's a wild shift.
It really is. Remember to check out that StockOracle trial link below. And again, always verify AI insights yourself.
Thank you for joining us on this deep dive. Keep questioning the numbers behind the narratives.